In this video, we're going to go over the top 8 stocks you're going to want to keep your eye on this week. We have 8 companies from various sectors of the market who are all reporting their latest quarterly results, which may lead to an increase or decrease in the share price. And as we do every single Sunday, we discuss around 7 to 8 different companies that are reporting their latest earnings, they have a new product launch, or any major newsworthy event coming out in the upcoming week that we should put on our watch list to see how the company performs. We're going to go over 8 different companies today. We have 7 strong blue chip companies, and we have 1 speculative company that is higher risk but has a history of surging after they post a positive earnings report, and that will be the 8th company we're going to take a look at today. We have a strong variety in the tech and retail sector this week, and these companies have a very strong dividend growth history. So in this video today, we're going to discuss all of these different companies, take a look at their current financial position, evaluate their dividend growth moving forward, and go over which companies we believe have the strongest future outlook. If you're new here, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy and sell within your portfolio, and in this video, we're going to focus on 8 companies you should have on your watch list for this next trading week, so please hit that like button and subscribe. The first company we're going to take a look at this week is JD.com. Currently trades at $92 a share. They are up 175% on the 12-month chart. Insane growth as of late, and the company currently trades at a $143 billion market cap with a forward PE of 60. So this is a Chinese e-commerce platform that has been growing rapidly, and of course we know as the pandemic continued to grow, the entire e-commerce industry across the globe has exploded, and this is one of those main players. If we take a look, they report earnings pre-market on November 16th. We're expecting earnings per share of 40 cents and revenue of $25.74 billion. And over the past 4 quarters, this company has done a great job. They've beaten each and every time over the past 4 quarters, and when they have beat, they've beaten by a significant amount. They beat by 13 cents, 19 cents, and once again 13 cents. And moving forward into future quarters, we're expecting massive growth from JD.com. Year-over-year expected growth of 38% for this latest report, followed by 216% growth, 83%, and 40% year-over-year growth. So a ton of expected future momentum for JD.com, and that is to be expected. They're in one of the fastest growing industries right now, and as e-commerce continues to explode across the globe, this may be one of the players you're going to want to take a look at. And over the past 5 years, their revenue growth has been insane. 5 years ago, they brought in $27 billion of total revenue, up to over $92.3 billion in the past 12 months. So they've more than tripled their top line revenue in a matter of 3 years, which is absolutely incredible, and a massive, beautiful upward trend year over year. And if we take a look at the bottom line, the company is profitable. So of course, a couple years ago, they were in the high growth stage, so they were losing money, but over the past 2 consecutive years, they've been posting some positive earnings, bringing in over $3 billion of net income in the past 12 months. So if you want to get into the e-commerce space and you already own the main players in the United States, like Amazon, like Shopify, this may be a company you're going to want to take a look at moving forward. Walmart is the second company we're going to take a look at this week. Ticker WMT currently trades at $150 per share. They are up over 24% on the 12-month chart and have a market cap of $426 billion. Trading at a forward PE of 28, this is one of the businesses that remains operational throughout the pandemic. Regardless of any shutdowns, Walmart will remain open and still generate revenue and net income, which is a solid company that you may want to add to your portfolio during this tough time. They've also done a nice job of innovating and growing. They have a new service called Walmart Plus to directly compete with Amazon, and they have a new partnership with Shopify, one of the largest and fastest growing e-commerce platforms in the world. So they're making a lot of strategic partnerships in order to help grow the business. They're innovating with new products and services, and I think it can really help Walmart stay on top as one of the largest retailers in the world. If we take a look, they report earnings pre-market on November 17th. They have a revenue estimate of $131 billion, and we're expecting earnings per share of $1.19. Over the previous 4 quarters, we have seen 3 beats on earnings per share estimates and 1 miss, and we're only expecting a slight increase on this quarter for year-over-year growth. Walmart's current dividend yield sits at 1.43%. They only pay out around 40% of their earnings as a dividend and have a 47-year dividend growth streak. If we take a look, their dividend is still considered safe with a dividend safety score of 78, very slow dividend growth last year of only 2%, and the company has a low beta, so not a lot of share price volatility within Walmart. Moving on to the third stock on our list today, we have the Home Depot. Ticker HD currently trades at $277 per share. They are up 18% this year and have a market cap of $298 billion. Current dividend yield sits at 2.16%, and they trade with a forward PE of 24.10. This is a company that I do not believe will get destroyed by the internet. The products they sell in their stores, I believe, will always be in-person shopping. I think they have nice wide aisles. I think they're nicely diversified across North America, and I think this is a brand that will continue to dominate their respective industry moving forward. If we take a look, they report earnings of pre-market on November 17th. We're expecting earnings per share of $3.02 and revenue estimate of over $31.8 billion. A lot of optimism for this company over the past quarter, 26 upward revisions in earnings per share estimates over the past 90 days, and only one single downward revision. Over the past 4 quarters, we have a lot of variance in their earnings report. We have 1 inline, 2 beats, and 1 single miss, and we're expecting a 19% year-over-year growth rate over this latest report. If we take a look at their dividend summary, currently yielding 2.16%, they pay out only 52% of their earnings as a dividend, which is extremely sustainable over the long term, and they are one of the best dividend growth stocks on the market. They have a dividend growth rate average of over 23% over the past 5 years. Absolutely insane dividend growth rate to see. So although the starting yield may be on the lower side of 2.16%, that dividend is growing at a massive rate, and it is considered very safe with a dividend safety score of 87. Last year alone, they grew their dividend by 25%, and you can see the exponential growth on that dividend right here in this chart. Nvidia is the next company we're going to take a look at this week. This is one of the largest tech firms on the stock market with a market cap of $328 billion. They've been on an insane run-up of 155% over the past 12 months, and this is a company that I think has run up too far. I don't think they support this large market cap right now, and if we see a pullback, it may be at an attractive price point. They barely pay out a dividend, currently yielding 0.12%, so I consider this primarily a growth company. Over the past 4 quarters, we've seen beautiful earnings per share beats each and every time, and we're expecting 43% year-over-year growth on this latest report. So they announced post-market on November 18th with an earnings per share estimate of $2.55 and a revenue of $4.42 billion. And we've seen 32 upward revisions showing some good optimism for this latest report and only 1 single downward revision over the past 90 days. If we take a look at their income statement, they have done a beautiful job of growing total revenue year over year, but $13 billion of total revenue, although they are in a growing industry that is expected to flourish over the next decade, I still don't think that warrants a $328 billion market cap, especially when their bottom line, they only brought in $3.3 billion of net income. If we take a look though, they do currently pay out a dividend, although it only yields 0.12%, it only makes up around 7% of their earnings, which is almost nothing. They have been growing it at a decent rate over the past 5 years, and because it's so low, they have a very safe dividend, which is considered 89. But once again, I don't really consider this company a dividend stock whatsoever because the yield is almost non-existent. Lowe's is a dividend king that also reports their earnings this week that may be trading at a nice valuation. The company currently trades at $159 per share and a pullback away from the $180 52-week high. They have a market cap of $120 billion and have a current dividend yield at 1.5% with a forward PE of 18. They are up 41% this year. They report earnings on November 18th. We're expecting a revenue estimate of around $20.96 billion, 1.95 earnings per share estimate, and 21 upward revisions and only 1 downward revision once again. Over the past 4 quarters, significant beats each and every time, and this quarter we're expecting 38% year-over-year growth. So this is a dividend king. They've been consecutively growing their dividend for 57 years. another massive dividend growth rate of over 20%, which is absolutely incredible, a 1.5% dividend yield, and they only pay out 27% of their earnings as a dividend. That is absolutely incredible. Although the starting yield is low, they grow that dividend at a massive rate each and every year, and consecutively growing it for 57 years while still maintaining a payout ratio of less than 28% is absolutely extremely impressive, and that's to say the least. The dividend safety score comes in at 93, which is considered very safe, and this company I hold in my personal portfolio and I plan to hold for a long period of time. Similar to Home Depot, I do not believe they're going to get destroyed by the internet and will continue to sustain and grow operations over the long term. So moving on, we got stock number 6, which is Target, ticker TGT, currently trades at $162 per share. And of course, this is Walmart's one of their main competitors in the physical retail space. Target's up 50% this year, markup of $80 billion, and a current dividend yield at 1.67%, forward PE of 22.2. So of course, like all of these companies, they report earnings this week as well. We're expecting them on November 18th. An earnings per share estimate of $1.61 and revenue of $20.74 billion. Another company with beautiful history of beating on earnings per share over the past 4 quarters, and we're expecting 18% year-over-year growth as well over this latest report. The 1.67% dividend yield, followed by only a 37% payout ratio, so very sustainable. This is a dividend king with 52 consecutive years of dividend growth, which is insane. So they've grown their dividend through good times and bad. 5-year dividend growth rate of over 6%. So although the starting yield is a bit lower, the dividend is growing at a nice rate. And the dividend safety score is at 90, so very safe, not worried about a dividend cut coming anytime soon. Transitioning in to stock number 7 of the blue chips, we have Intuit, ticker INTU, up 36% this year with a markup of $93 billion. So this is a company that has a very low yield of only 0.66% and a higher forward PE of 42. So if we take a look at their earnings, they report on November 19th after market close. We're expecting around 42 cents earnings per share and $1.22 billion of revenue. So another company that's been up really fast over the past 12 months that I think needs to see a decline to get to a fair valuation. They've beaten over the previous 4 quarters, and we're only expecting a slight growth rate this year. The dividend is only at 0.66%. They pay out around 27% of their earnings as a dividend, and of course, with that such a low yield, that low payout ratio, they do a nice job of growing that dividend at over 18% average over the past 5 years, and their dividend safety score comes in at 98, which is considered very safe. Moving on to the final stock we're going to discuss today, this is the riskier play, the more speculative company, and that is NIO. I've talked about them a bunch on this channel. They are very popular and people really do enjoy this company, but over the past few weeks, they have been on a massive run up. They are up 2,245% on the 12-month chart. Over the past week, we have seen a decline, but on the 1-month chart, they are up 100% in a month. But over the past few weeks, we have seen a slight decline. You can see here where they peaked at around $53 to $54 per share, and we have seen a significant decline since that point back to that $44 range. But another company where if they report a positive earnings, we may see the share price explode. This is a company that, of course, over the past 12 months has done nothing but go up, but still positive earnings may send them soaring back up to that $50+ mark. They report after market close on November 17th, revenue of $616 million estimate, and they are losing money each and every year, but over the past few quarters, they have beaten expectations slightly, and we're expecting a 52% year-over-year growth rate from NIO. So this is a more risky play. They are up ridiculously amounts over the past 12 months, up over 2,200%. Put this in perspective, 12 months ago, you could pick up a share of NIO for less than $2, and their 52-week high is at $54. So they went from $2 to $54 in a matter of a year, and they also are back down to $44 right now. So very risky company. Take a little more research into it. Take a look at my previous videos if you want to learn more about this stock. So the 8 companies, they all report earnings this week. Like we do this every single Sunday, please hit the like button and subscribe, and I will see you in tomorrow's video.